Hello, ladies and gentlemen. Well, what a week. We've seen an incredible range in the S&Ps and all stock markets, really. I show you the Blue Angels first because I think the situation is complicated and simple at the same time. We have bounced off the 15 times Blue Angel, which is around 26.20, and now we are ranging between the 15 times Blue Angel and the 16 times Blue Angel, which is at 2800. 2725 being the midway point just about is going to be seen very, very often. Now, what are we going to do after that? Well, your guess is as good as mine. We have so many headline grabbing opportunities for the market to decide to make a move after that, that the most probable thing is that the market will take a long time making its mind up. We have the meeting between Xi and Trump towards the end of the month. We have the elections next week. Although if you ask me, I have absolutely no idea what is a good outcome for the market and what is a bad outcome for the market. You can make arguments either way. All I know is that every time it drops down towards 26.20, you buy with both hands, and every time it goes anywhere near 2800, you buy put spreads. Well, the bonds are doing exactly what they should do after a very strong number for NFP. You have the 5-year now over 3% in yield. It'll probably get to the level it tried to a few weeks ago, which was 309 or just short of 310. The 10-year is definitely will trade 325. It's now 321, and the 30-year is the one which is really moving. And look at how, if you have a look, this is textbook retracement to the line, and basically it spent 1, 2, 3, 4, 5 days going down and closed through the Bollinger Bands. That means a bit of sideways and then down again, most probably. So what is the curve doing? The curve is steepening. The 2s and 5s is where people are parking money, and the 30s is the stuff that nobody wants. This situation is unsustainable for stocks because at some stage, when interest rates get high enough, we're nowhere near there yet, this is going to cause recession. And that is probably what the market is actually anticipating. It is anticipating by ranging between 15 times the Blue Angels and the 16 times the Blue Angels, a recovery which is extremely long in the tooth at some stage coming to a grinding halt. This is a chart of the spread between 10-year bonds and 10-year in the US. This was the level that I said a few weeks back was so important, around 258. We're now 278. While this spread is this wide, I just cannot see the dollar getting sold heavily. It is just, unless we break, let's call it 272, the middle of this Bollinger Band, and start cascading round towards 264, it is very unlikely that the dollar will get much weaker than it is now. This is a fundamental move, and however much Trump might like to keep the dollar weaker, however much the Chinese are playing with our currency to influence the talks on the in mid-November, it is unlikely that we're going to see much weakness in the dollar while this picture is prevalent. This is fundamental. There is absolutely no reason to fight it. And here is the dollar. If we enlarge it, what has it done? It's closed right on top of 96.50. They are trying to keep it offered to help the trade talks. As simple as that. But longer term, this picture actually looks to me very bullish. As I showed you, the spreads keep on going out. The Bund moves 2-3 basis points. The 10-year moves 5 to 10. That is not a recipe for the dollar being sold or being offered. Just because sterling surges one day or whatever, that is not a recipe for dollar weakness. It's a technical correction, and then the dollar just comes back. We are very happy to be long of dollars while having put protection to the downside. Turning to equities, we actually today, Friday, we've done very little. And if you have a look at actually what we've done, all we did is we came back and we tested the confluence of these moving averages, and we closed still above. That to me would probably encourage over the next few days some sort of a relief rally back up to the 200-day moving average, 27.60 something, maybe even surpass it. But I still think unless we close below these levels, unless we close below 27.10, the upside seems to be the first direction that we go into. And then around the 28 level, 2800 level, that is about as far as I can see it going for the time being, and it should come back and probably retest all the way back down towards 2720, 2725. Quite convinced the market has suffered so much internal damage that we are not going to have a V, we're going to have a range. Whether we go up to here and then at some stage come back only down to 2710, I don't know. But as you can see, could we develop an inverse head and shoulders? Of course we could. To me, that is actually unlikely. I think too many people will be watching it. It is more likely than not. I think that at some stage, once the market has been holding in, it actually gives up the ghost and comes right back down towards 2620. Even on a shorter period time frame, something like the 10-minute that we have here, we can see that actually what happened today, Friday, the last day, is absolutely no tragedy whatsoever. All it's done is it's come back to meet the moving averages, and now actually, unless it starts breaking through 2700, it's in a very good position to even take out the 2750 level and trade around the 2775 level. That is as intelligent as I can make this. It's actually a crapshoot against the market's reaction on to the midterms, but I think the likelihood is the odds are that we trade back up towards 75 rather than break down through 2700. But at that level, that will be a wonderful place to actually put on a bunch of put spreads, looking not only for the gap fill here, but probably a full retest of the lows. How does that analysis match up with what volatility is doing? Volatility on a daily basis, the VIX, is actually, all it did today is it went and retested this red line and came back down. It is quite likely now the volatility trades down towards 16, and that is where you want to buy it. This is where the 50-day and the 200-day moving averages are. That's 3% down. Let's call it 16.5. That is where you want to be long volatility, and we will definitely do that trade because the risk reward is so good. I wanted to have a quick word about Nasdaq because I truly feel that Nasdaq is dangerous. It is not so much dangerous because it's going down. It's dangerous because you don't have a 15 times Blue Angel to catch it. The valuations in the Nasdaq are very stretched, and a panic can be just that, a complete panic. It can move percentage points in minutes. As you can see, excuse me, it keeps on spiking the Bollinger Band on the weeklies. Another 2 or 3 weeks of that, and these Bollinger Bands will have widened out enough that if it starts cascading down, I just don't know where the bottom would be. It is the one that's probably gives you most reward on the upside, but it's also the one that is so dangerous. And I think that these high beta stocks are just something to be avoided at the moment. I would definitely keep away from Nasdaq, and I would certainly trade something or hold something far more conservative like the Dow. I will now show you the Dow and you'll see it's a completely different picture. This is the weekly chart of the Dow, and you can see it's actually trading much the same level as it closed the week that we dropped down from the highs. So it's actually holding in far better than Nasdaq and far better than the S&Ps. Its quality, you will see the even though Apple disappointed and gave it a bit of a kick, the other stocks have really taken up the slack, and all we're doing is basically trading in this kind of range, 25,500 down towards 25,250. That is a much more conservative instrument to hold for the time being until resolution occurs. On to Europe and the DAX. Well, this could be a textbook head and shoulders, which, as you all know, what do textbook head and shoulders do? They actually retest the shoulder. So it's quite likely that we could see the market come back up towards 12,800. Very likely that we get that kind of a move, 12,800, and that is the level that would be so wonderful to get some put spreads on, because from that level the market really has an opportunity to break down very hard. I was asked to have a look at to actually explain why I think this market is quite reminiscent of 2000. Well, it's actually because we've gone all bullish. We went all bullish into 2000, and the market just broke hard at some stage, even though the economy was nowhere near turning, and it gave you a couple of warning shots, like here and then here, and then finally never really crossed the red line in the never closed above it in terms of the monthlies, and it just stair-stepped down all the way down to the 15 times Blue Angel. If we compare that situation to now, we have a situation where we just held in, broke, and now we are deciding whether we will continue to break or not. To me, this is reminiscent. If we don't close above this line, which is what, 2740-ish, if this month we can't make it above 2740 on a closing basis, the odds shift very, very heavily in terms of a sharp move down towards 2400, sometimes either in December, January or February. But it's going to be a very sharp move, basically, you know, the A, the B, the C. It's going to be very nasty. It just reminds me that the market is leading the economy, and that's why it's, to me, is reminiscent of 2000. You would have thought that a figure like today's would have given stocks some impetus. To the contrary, they sold off and they couldn't hold above the 27, 30, 40 level. I think it'll try. I think it'll try for that line, which is around 2800, and then if by month end we can't hold it and we are underneath it, I think it's probably all over. Well, the biases. As I said, the curve should begin to steepen. It is steepening. TLT still has a chance of collapsing. It is. 2 and 5 year areas where you park your money, that is where you lose the least. It doesn't matter, you can reinvest. To me, that is the area that you want to be invested in. That is that. Yields are going up worldwide at some stage. Bunds and bobbles are by far the most conservative. They're the ones that move least, simply because they're being pushed and pulled by Italy, by reinvestments by the ECB. Just not a market that you really want to get involved in. Certainly all you want to do is you want to wait for it to get overbought and then sell it, or buy some put options on bunds. That is about as much as I would do there. SPX times 15 Blue Angel 2625, times 16 Blue Angel 2800. I will be very, very surprised if it closes outside of that range for the next 2 or 3 weeks. To me, NQ is looking increasingly vulnerable because it's lost all leadership. People are buying the dips on, you know, basically on a wing and a prayer. But to me, at some stage, NQ could have a real problem. Unless you have very good reasons to be long of it, I would avoid it. And I gave you the level to buy. It's 1650. That is really where we will make a stand, and we think that that would be a very interesting place to be very long of call spreads in the VIX. European equities, I showed you what I think of the DAX, 12,800 if we see it and we still have a chance. Put spreads, we will definitely be doing this big time. Told you what I think about the dollar. It's at 96.50. I just cannot see it being sold heavily. I want to have downside protection because of these trade talks and manipulation of other people of their currencies, like the Chinese, which affects the euro, which affects the DX. But I cannot get short of it. To me, this is still the important thing. Stay long of where you have a bit of a tailwind, i.e. Nikkei and Dow, and short stuff which is high beta and people might want to dump at some stage, which is like NQ, SPS in Europe at the levels. These puppies we sell at good levels. This I would just avoid. Because it could get really scary at some stage, unless you have a very good reason to belong some component, which of course is perfectly legitimate. Thank you very much indeed, and have a great weekend. Tweet you on Monday.